Good afternoon, David. Well, David, perhaps starting with that euro-dollar, because we did see the euro strengthening above 125 against the dollar last week. And this is a breakaway from the norm, because generally when we have the markets weakening as they have been, the dollar tends to benefit from that. Why have we seen this break, David? Do you think investors are starting to recognize the problems we're seeing in the United States?
Yeah, I think so, Stephen. It was quite a surprise that we did, for me in any case, that we did see the euro rally to the extent that it did. I think there's a number of reasons that's happened, and I'm not too sure at this point in time whether it's a focus shift onto the dollar. One of the reasons is that over the last sort of 6 months, the euro has become the funding currency for carry trades around the world. And of course, as we saw the Europeans tackling their fiscal problems the way that they did with their austerity measures, and we saw concern around the global economy, a lot of those positions were unwound, and we did see the euro track much higher, and currencies like the rand, Aussie and Canadian dollar weakened substantially against the euro. I think for the moment it's a little bit too soon to tell whether this is a shift away from the dollar or shift onto the US problems, as they've done nothing about the fiscal challenges that await them down the line.
Well, in the meantime, we have the rand trading around 774, so weakness continues to come through from the rand against the dollar. How are we looking against the crosses at this stage, David?
Yeah, the rand has, did a lot of its weakening work against the crosses late last week. I think we're waiting now to see whether the sort of equity market sentiment, the sour equity market sentiment that we have seen over the last few sessions, if that follows through. If it does, then the rand will continue to weaken against the crosses and against the basket of currencies, simply as investor sentiment is not great at the moment, Stephen.
Well, of course, David, we had lots of economic data coming out last week. Culminating with the US non-farm payroll data on Friday. Of course, we had ISM and PMI numbers out as well over the course of the week. This week a little bit quieter. How do you think that's going to play out on the markets? Do you think we need time to digest some of the negative data that has come through?
Yeah, I think the market nervousness is certainly justified at this point. We've certainly been calling for a weakening rand for some time now, and perhaps our call was a little premature. But there's no doubt that the global economy is in a little bit of trouble at the moment, and you've got two schools of thoughts, and indeed emerging out of the authorities, from the Fed to the European authorities. The Bernanke and his allies calling for more stimulus to come through, and others saying, no, we can't afford it. We simply can't afford higher deficits going forward, and we need to do something about them now. And I think the nervousness that we're seeing in financial markets, particularly in equity markets, are justified. I don't think the global economy is on a sound footing at all. And I do see some further downside for equity markets, which will of course put pressure on emerging market currencies.
And of course, as you mentioned, the US not taking any steps to tackle its own deficit, and we know what that deficit looks like at this stage. I mean, which is the best scenario to avoid a double dip? More stimulus spending or cutting of those deficits, in your opinion, David?
Stephen, the problem for me as far as the global economy is concerned is that there's simply no easy solutions. When we look at the ammunition stores, they're relatively empty, or they, in fact, beyond relatively empty. There's just nothing left to do besides print more money and more stimulus. And we know that that's Mr. Bernanke's view. He's obviously infamous or famous for quoting that the US can print money and effectively drop it from helicopters to make sure that we don't head into a double dip recession, or in fact worse than that. But whether that's a long-term sustainable answer, that I don't agree with that, simply because that's what we've done in the past, and that's a typical sort of Keynesian response that we've had, and arguably that's why we're in the problems that we're in at the moment, and that's why I foresee a bumpy road ahead and weaker equity markets. I'm not sure that there's much more that the authorities can do, and further easing or printing of money is simply going to create bigger problems down the road, and hence my nervousness and my bearishness as far as global markets are concerned in the medium to long term.
How about the data coming out from China? We had that PMI number out last week, and the HSBC PMI barely above the 50 break-even level. Does that give you cause for concern? Do you think we have been looking far too much to China to get us out of this mess?
The big dilemma for me as far as China is concerned, Stephen, is traditionally, over the last sort of couple of decades, they've been the world's producer, and the West, certainly America, being the great consumer. My reason for nervousness is if the Americas have lost so many jobs, and indeed the Western world has lost so many jobs, who's consuming the goods that China is producing? I'm not very confident. We've had concerns about a possible Chinese housing bubble. We did see some consumer data come out this morning of China. New car sales have slowed, and my great fear is that we have a huge slowdown in China, and that's not good for global growth, as well as all these job losses and poor data coming out of the Western world. It could really be a serious problem.
Well, just looking forward to this week, we had some EU retail sales and non-manufacturing PMI out just a short while ago, and pretty much a little bit worse than expected. We've got the Royal Bank of Australia tomorrow deciding on interest rates. What's your view? Because, of course, Australia is one of those large economies that didn't go into a recession. Do you think that they're going to keep interest rates unchanged? Do you think they're still going to continue raising them?
No, my view is that certainly rates will be on hold in Australia. As they wait to see the global impact. And my other fear at the moment, Stephen, is we haven't seen the worst of the data yet. I think we're only beginning to see the slowdown data coming through, because one must remember up until the debt crisis hit fully fledged in Europe, data coming out of the rest of the world was fairly positive, and we're only beginning to see the first signs of a slowdown now. So, as far as I'm concerned, things are not very rosy, and we've certainly got some serious head scratching to do in the weeks and months that lie ahead of us.
Of course, key data in South Africa this week. We have golden forex numbers coming out. We also have the manufacturing data coming out, I think, on Thursday. Mining data, as far as I understand, has been postponed. What are you expecting from that manufacturing reading, given the way PMI has been going?
Yeah, I think, as I think I said last week, South Africa is a sort of a microcosm of what's going on in the rest of the world. Recent data in South Africa hasn't been great, and in fact is perhaps creating a little bit of pressure for the MPC to cut rates in the not too distant future. And I think we'll see some accumulation of reserves because what we have seen, or what we've heard, rumours of central bank activity in the markets as they've become very, very concerned about a strong rand and how that's impacting the manufacturing. So my sense is that we're not going to get great numbers coming forward. It's going to show perhaps a tapering off of growth, recent growth in South Africa, and perhaps cause or reasons for another interest rate cut in South Africa to try and stimulate that growth, as credit demand is non-existent, money supply demand is non-existent, and inflation, besides the sort of wage demands that we have seen come through from the public sector, inflation also non-existent in South Africa.